Over the years, you've heard me ask wealth manager Warren Ingram the big questions. How do we invest wisely? How do we protect our family's future? All those conversations, that entire library of financial expertise is now available as a podcast. Straightforward advice to help you build your wealth on demand. Just search for Warren Ingram's Personal Finance wherever you get your podcasts.
Burning questions.
Insightful answers.
Listener's choice.
With Clement Manyathela.
15 minutes after 11 o'clock. Time for our Listener's Choice feature. And today we're talking about shares. One of our listeners has asked that we discuss investing in shares, and we will share with you what are the most important things to consider before you invest, right? Because, buying shares in South Africa has really become easier than ever, thanks to the digital platforms, the accessible education, and, of course, fractional investing. And whether you are starting with 100 Rand or 1,000 Rand, the most important step, of course, is to be clear with your goals. That is. So, reliable tools are important. You need a long-term mindset, perhaps, if that's your goal. But the process is not always clear. So how do you start? How do you manage the risk in this volatile economy? Which shares do you buy? Where do you buy them? While experts cannot explain exactly what shares you should be buying, they can guide you. And that's why we've invited Rudolph Geldenhuys, who's a certified financial planner, to chat to us about investing in shares. Rudolph, thank you for making time. Good morning.
Good morning. It's so wonderful to be here.
So when we talk about investing in shares or buying a share in a company, what exactly do we mean?
That means that you as an individual would own a piece of the company whose shares you bought. So let's look at the Johannesburg Stock Exchange, and some of the companies listed on the Johannesburg Stock Exchange would be businesses that we know really well because we're on their premises every day. Companies like Shoprite Checkers or companies like Spar. So I would then make the decision to go onto a stock broking platform or buy a share of Shoprite Checkers. Why is Shoprite selling a share? Well, they're raising capital so that they can expand their business. And in exchange for my money, so buying a share from them, I own a piece of Checkers now. And that means that if the company performs and the share price increases, the value that I have in that share is increased. So I've grown my wealth, and I also get a portion of the dividends. So at the end of each year, some companies declare a dividend from some of their retained earnings. So if the business did really well, they want to give back to shareholders. So now in exchange for some money that I gave to Checkers, I own a share and I get a dividend, and hopefully the shares that I buy in all these companies will grow in value and I will create wealth in that way.
So how do I get the dividend? Like, is it something that could be paid on a monthly basis? Is it something that gets paid at the end of the financial year? How does it work when you've decided to invest in, let's say, Shoprite?
So it depends on the dividend policy by each company.
Okay.
So some companies declare annual dividends. Some companies have got more regular dividends. But when they pay a dividend is less important than the fact that as a shareholder, when a dividend is declared, that money comes back to you. So let's take an easy example. Let's say one of these stockbroking accounts. I bank with FNB. So on my FNB app, if I want to buy some shares, I simply go onto the FNB app, would take some money out of my bank account and would buy a Shoprite Checkers share. When Shoprite eventually declares a dividend, that money will come into my share portfolio, and I'll see it as, hey, I've got some extra money in my share account, which was cash from the dividends received, and then I can decide, am I going to enjoy the dividend or am I going to maybe buy some more shares?
Okay. So what should people then, what platforms are better to use? I know there are many online platforms, whether you talk about Easy Equities or Cetrix now, the banks, as you've just indicated. How should one go about choosing the right platform so that people don't end up being scammed?
Oh, that's a great question. I think you need to do a little bit of research. Like, is this a real company or is this some kind of scheme to get my money? So that's the first thing. I think establishing the credibility through some research. Do they have all the licenses? Are they registered with all the important bodies? Like, can they actually become a stockbroker? That's a good question to ask. So reputable companies like if your bank has got a share trading platform built into your banking capabilities, that's probably one that you can trust immediately. So F&B, they've got one built in. So, I mean, I wouldn't doubt for a second that my shares that I purchased via my F&B bank account would not be a safe and secure approach, right? I guess how you would determine which share portfolio or which share platform you actually invest in would be due to a couple of things in my mind. Number one, the ease of use. Number two, the cost involved. And number three, am I in control of the information? The shares that I've bought, is it actually in my name? Because sometimes there are funny schemes out there where you pay money to somebody and on my behalf, Clement, you would maybe go and buy shares for Rudolph. But, I mean, that doesn't necessarily mean the shares sit in my name and I can decide if I want to keep them or sell them. So those would be the three key factors. Is it easy for me to use? Can I see my information? Do I get my tax certificates? And can I easily buy more shares? Can I easily sell shares if my needs have changed or I need access to some money? And is it low cost? Because some are quite expensive and others could be a little bit more affordable.
Okay. What kind of documentation or requirements are needed to open a trading account?
So if it's an account maybe linked to your bank, it's an automatic process. Because the bank has already figured me, then it's quite simple. You literally would just go on and say that you want to open up a share account. Let's say you want to make use of an external third party like an Easy Equities that you mentioned. Great platform to use, easy to navigate. Then you would need a copy of your ID so they can do a due diligence on you. It would be a proof of your address, part of the FICA process, and potentially a proof of bank that they can just identify you due to any anti-money laundering requirements that we now have in SA because of grey listing. So all the platforms just want to know ultimately who is Rudolph that is buying shares and can we trust him or is there some dodgy things we need to know about, and they can determine that from your info.
What are the risks, Rudolph, to be aware of? Because we often hear that investing in shares comes with risks. How does one manage that, especially in this volatile economy?
Yeah, of course, there are risks with anything, right? So let's break down risk in two ways. So we can either have the first risk, which I would term as volatility, as you mentioned, a volatile economy. That is the risk that I run of the value of my share portfolio going up and down as we go through the market cycle. And you can't get away from that risk because as we go through market cycles, as the economy does well or it comes under pressure, that has an impact on the share valuations of the companies that I bought in. So if, let's say I bought Shoprite Checker shares and the company's under pressure because of additional competition from Woolies and from Spar and from Pick n Pay, in the short term, people might think, I don't know if Shoprite is at this stage actually such a great investment. So I'm maybe going to start selling some of my Shoprite shares. And when people start selling shares, it has an impact on the share price due to supply and demand. So then if I've bought a share for 100 Rand from Checkers, I could end up a month later with that share being valued at 90 Rand. But I haven't lost money yet because I still own the share. So that is called volatility. The other risk, which is much less likely, is the fact that my share value drops to zero. I mean, we all remember Steinoff. It was already some years ago, but it's still fresh in a lot of our minds. More often than not, that's not a risk that I lie awake about at night for my clients, thinking, what if some of the shares we own in all of our portfolios that we manage would actually drop to zero? Because the reason Steinoff dropped to zero is that was just absolute fraud and theft and mismanagement. But that's not because of market cycle or competition or maybe some excitement around a new opportunity or a new business unit that Shoprite has launched. So remember when they launched that Shoprite Outdoor business unit? Like, hey, that's something new, exciting. So it increases sales and would obviously increase the share price maybe in the shorter term. But it's not a risk to my capital that the thing that I've bought will drop to zero. So why do I mention the difference between the two? We need to be aware that as much as share prices go up, they've also gone down in the past. And over the longer term, owning shares is the only thing, or one of the few things, that helps us build wealth. We can't grow our wealth with money in the bank. We actually almost want to run a bigger risk of having too much money in the bank than money in assets because of inflation. So owning an equity, owning some shares, building wealth slowly but surely through regular savings, regular contributions, is going to grow our wealth. And yes, part of that is this risk of the value going up and down. But we need to have a long-term view. Like, share investing is not a 1 month thing. It's not a 1 year thing. It's a much longer time frame. But we get rewarded for that through the dividends and through the share price increase.
Okay. If you've got questions for Rudolph, you can call us on 011-883-0702. WhatsApp's on 0727021702. I did get a question earlier about unit trusts. Are those a safer option, for maybe people who are not confident in picking individual companies?
Yeah, unit trusts are great tools available to each individual South African. And let's compare apples with apples. You either can buy your own shares, or you can invest in a unit trust that has exposure to a lot of shares. So it is maybe an option to consider if you're concerned that if you have to go and pick your own shares, that you're not going to do the best job at it because it takes a lot of work. It's a lot of smart people that normally play in that space. And you need to do a lot of research to determine, should I be buying ShopRite or ShopRite or Pick n Pay or Woolies or Spar? Or alternatively, some unit trust just invests in all four of them. So you have a diversified approach. So a unit trust is simply investing alongside a lot of other people. We collectively combine our money and give it to somebody like a fund manager who will then, on my behalf, on your behalf, all of us in this unit trust now go and buy shares for us. And then it pretty much works exactly the same as owning an individual share. I think it just brings about an additional layer of control, additional layer of diversification, peace of mind that there are other people involved who are maybe a bit smarter than I am.
All right. There's a question here about investing lump sum. Someone wants to know if they should invest a lump sum all at once, or rather maybe start with a smaller amounts. Before you respond to that, here's a WhatsApp voice note that's also come through.
Morning, Clement and team. Can you please ask your guest there what are the most reliable trading instruments that one can opt for or that are available? Like if you want to trade cryptocurrency and so on. Thank you, Sipo from Tembis.
Thank you very much, Sipo. Rudolph, those two questions?
Yeah, so let's tackle the first one, lump sums versus regular contributions, so like monthly debits. I think over time it comes out to the same thing. You're actively deciding to put money away for your future. You're buying quality assets. You are actually just starting to accumulate money in assets that'll grow over time. I guess the pros and cons would be, if you have a regular debit order, you keep buying shares regularly, if we stay on the topic of share investing. So whether the market cycle goes up or down, you are getting into the market at different spaces. So this month, the ShopRite Checkers share, in my example, is 100 Rand, so you buy one Checkers share. Next month, the share price came down a little bit, so it's 90 Rand. It's still a good quality company. Nothing really changed fundamentally about the company. Now I'm getting more than one share because I'm investing 100 Rand a month, but then next month, it's 110 Rand a share. So I'm able to, I guess, spread the risk of the up and down market movements. Whereas a lump sum, if I put it in today in the shares, I guess I'm more exposed to what the current market conditions are and what the current share prices are. But if we stretch it out over 10 years, we probably might not really see a distinct difference between investing 100 Rand a month versus investing 1,200 Rand once a year. And then I guess the second question is around the platforms available and the kind of products utilized. I think there's so many of them. You just need to make sure that they're reputable and that they're doing what you need to do. I mean, the caller who sent the voice note spoke about cryptocurrency. I mean, that's a very different kind of asset than a share would be. And some platforms like Easy Equities, I think they've now got a section where you can buy a cryptocurrency ETF. That's never mind whether you should buy it or not. I mean, that's a personal, I guess, conviction or what you're trying to achieve. But you need to then try and find, okay, if I want to buy cryptocurrency, let me find the best, most, or the safest and the most cost-effective cryptocurrency platform. If I want to buy shares, I need to try and find the best, most effective, cost-effective, access to information, the safest one that I understand, and do that for my shares. If I want to invest in unit trust, I need to find the platform that will give me the best approach in order to execute that. That would be my I guess, feedback on that.
All right. Rudolph, I'm just going to take the latest in Eyewitness News headlines, if you don't mind. I'd like to come back, if you can take maybe 2 or 3 more questions before we wrap up this chat. It's 11:31.
Burning questions.
Insightful answers
Listener's choice.
with Clement Manyathela.
All right, we're wrapping up our conversation with Rudolph Geldenhuys, who's a certified financial planner. We've been talking about investing in shares and some of the questions you have around that. So I want him, before we wrap up this conversation, to at least respond to at least 2 or 3 more questions. So let's listen to some WhatsApp voice notes.
Hi, Clement, and thank you for your wonderful talk on shares. But forgive my ignorance. I was wondering if your guest could just explain to us in terms of how many shares a company can put out there, and is there a possibility of, for example, an individual becoming a majority shareholder in a company through the buying of these shares?
Clement, hi, and hi to Rudolph. I just want to find out from him, Easy Equities. We get advertisement from them every time about how to buy shares and so on. Is Equities legitimate type of sort of like share buying? They got an app, they're online. What's his advice? Charles, Kensington.
Hello, Clemmy. Can you please ask Rudolph, can I buy shares, you think, let me say, can I buy shares from other banks, not having account with those banks? Like, for an example, I'm in a Capitec, and then can I buy shares from Absa, Nedbank, and the other banks?
All right. Thank you so much for your questions. Rudolph, the first one was about how many shares a company can put out there, and can you become a majority through buying the shares? There's a question about Easy Equities, and then this last question about buying shares from other banks, even when you're not banking with them.
Let's tackle the first one. So each company, when they launch their company, and I mean, we're talking about listed public entities here. We're not talking about private companies. So when, for example, Shoprite Checkers decided to move from a private company to a listed public company, part of that process was to offer shares to the public. So they, for example, started with 1 million shares, and people could buy one of those millions of shares available for a fee, and that is how they raised some capital in order to expand the business. And now I'm a shareholder, part of their journey. I get some dividends in the process. I can absolutely keep buying those shares if they are publicly available. And over time, if I buy enough of those shares, if I had the capital for it, I could become a majority shareholder. It's probably very unlikely for the public listed companies that individuals would become majority shareholders just by nature of how large these institutions are. But for smaller entities, yes, absolutely. Then the question just becomes, what risk are you taking on by becoming a majority shareholder or a major shareholder? Like, is that part of your financial plan? If I own, for example, 10% of Checkers, which is a large amount, like, would that be the only thing that I own? And what is the risk to my long-term financial future by having one single share, for example? But yes, you can. You can absolutely become a shareholder, like a majority shareholder. But I think the first part of the question is, how many shares do they have available? Well, that is just determined in their, like, when they listed, they decided, we want to have 1 million shares. It could have been 100,000 shares, or it could be millions of shares. That's, I guess, less irrelevant to what the company does, the value of each share, and how many you want to acquire.
Got you. Was it all the questions?
No, there was one more. One more about shareholding, I think, in general, and then one about easy equities.
Yes, please.
So far, I've heard nothing to the contrary that easy equities is not a reliable business. I mean, for example, I personally have an easy equities account. Works really well. It's fun to use. Access to information. So I'm not concerned about them necessarily being a fly-by-night company. Can I say that no issues will ever arise with easy equities? No, that's impossible. But so far, no red flags. So that's a good thing. And then the last question around how do I buy shares? Let's say you're a Capitec Bank account holder and they don't yet have a share platform. Yes, of course, you can approach a FNB or an ABSA or a Standard Bank if they have this share trading ability. But you just need to then investigate the costs associated with opening up that share account. Are there monthly fees? Do you need to have an account with them? And are there fees to buy or sell the shares? Once you've answered all those questions and it makes sense, then it's absolutely possible to explore one of those options.
All right. Rudolph Geldenhuys, Certified Financial Planner. You've been great in responding to some of the questions we have around investing in shares. Thank you for making time for us. It's